Hello everyone. Whenever we think about the term life insurance, the first thing that comes to our mind is pure life coverage, a financial protection of our life for our loved ones in an unfortunate event of death. However, not many people are aware that life insurance can actually be used as an investment and effective tax planning tool. Today, I, CA Rajit Kothari, will discuss ways and means to use life insurance as a tool of tax planning as well as investment planning. This will help minimize the burden of taxation and maximize the returns from the investment. I will discuss two different techniques to make this possible. Technique number 1, guaranteed tax-free income strategy using life insurance. A life insurance plan can be obtained in which the premium payment can be spread across tenures ranging from 5 years to 15 years, and the repayment or the maturity can also be customized in a manner that is suitable as per the financial goals of the particular investor, along with the life insurance coverage that is available till the redemption or till the maturity proceeds are received in that policy, can be initiated after a cooling period on the end of the premium payment term. That is a certain number of years once the premium payment cycle ends. Let me explain you this policy with the help of an illustrative example.
This is an example of a guaranteed return income insurance plan for a person who is 30 years old, with the policy extending to 42 years till the time the person turns 71 years of age. The outflow is in 10 different annual installment with a cooling period of 2 years, and thereafter the inflows which extend till the end of the guaranteed income plan. The person also is assured a death benefit or a life cover till 12 years of the policy when the inflows begin.
The advantages of adopting such a guaranteed income life insurance strategy are: number 1, tax-free income. As per the Indian Income Tax Act, the maturity proceeds received under such a life insurance policy are completely tax-free in the hands of the investor if the life insurance coverage does not exceed or is up to 10 times the annual premium that is payable on such a policy, and the annual premium does not exceed 5 lakhs of rupees per individual. Therefore, within a family, there can be multiple such policies, including that of the HUF, wherein the HUF is the proposer and the life insured is one of the members, through which an entire planning can be done, in which a guaranteed income of a substantial amount can be generated over long tenures. Advantage B, guaranteed incomes for very long tenures. This kind of a life insurance cum guaranteed planning strategy assures a certain rate of return for tenures as long as 30 to 40 years. This protects the investors from fluctuation in the interest rate cycle in the economy. To give you an example, let's say an investor places a deposit of 7 years with a bank, and on maturity, the interest rate regime in the economy is on a downturn. Under such a scenario, the investor will have to renew the deposit at a lower rate of return, which will compromise on his earnings in the future. This will not happen in case of a guaranteed income insurance planning strategy, since the investor is guaranteed a certain level of income for very long tenures. Under the current circumstances, when the Indian economy and the rate cycle is considered to be at the peak, and we expect downturn in the interest rates by the Reserve Bank of India, it is an ideal time to lock in the rates for very long tenure to have the desired level of incomes in the longer run. Advantage C, customization as per the financial goals. The cash outflows as well as inflows under such a strategy can be customized and designed to meet the financial goals of the investor as and how he sees his future desired goals, which could be children's education or marriage or building a corpus for retirement. The investor has clear-cut visibility of receiving this amount of cash flow irrespective of whatever is the state of economy or the ups and downs of the stock market at that point of time. This provides a lot of assurance and confidence to the particular investor who is building a future corpus. Advantage D, life insurance coverage. Last but not the least, and the most obvious advantage of this kind of a strategy is a life insurance coverage that is available to the investor over and above the other benefits of investments and returns discussed so far. Technique number 2, equity oriented investment through unit linked insurance plans. This life insurance plan, called as ULIP, provides life insurance coverage along with investing the premiums into equity market, just as equity oriented mutual funds, which gives the dual benefit of life insurance plus participating in the growth of the Indian economy and the growth story in the times to come by allocation in the equity markets. The advantages of adopting this type of a strategy are: number 1, tax-free income. The maturity proceeds received on sale of a ULIP are completely tax-free in the hands of the investor if the life insurance coverage is at least 10 times the annual premium payable on the policy and the annual premium under the ULIP does not exceed 2.5 lakhs per individual. Therefore, multiple policies within a family can be planned to maximize the amount of tax-free income in the longer term. Advantage B, equity investing with tax-free internal switching. The premium amount of a ULIP can be allocated into different kinds of strategies which can be deployed in the equity market, which could be a small or mid or large cap kind of a strategy, or a theme based investment which suits the financial profile of the investor and which he thinks fit is suitable as per his financial goals. This will not only help the investor in meeting his financial targets of participating in the growth of the stock market, but also the investor can do internal switching into different kinds of strategies without any tax implications as per the changing market trends and circumstances of the economy. Advantage C, return of insurance charges. The ULIPs that are held for longer tenures are refunded 2 to 3 times of the insurance costs that are incurred in the policy in the initial period in form of mortality charges, premium allocation charges, etc. back to the investor and are added to the corpus over longer terms. Moreover, bonuses in form of additional amounts are also added to the corpus to maximize the yield and overall return from the investor on the policy. Advantage D, life insurance coverage. Last but not the least, ULIPs also provide a life insurance coverage which is over and above the other benefits of investing into the equity markets. Let me help you understand the entire ULIP policy with an illustrative example.
This is an illustrative example of a unit-linked insurance plan for a person who is 30 years old and which extends up to 10 years of annual premium payment. We can very well see that the person gets benefits in terms of bonus payments or return of insurance charges when he turns 39, 44, 49, 54 years of age, so on and so forth, which leads to accumulation at the fund at the end of the year, which improves the overall yield or return from such an ULIP investment. Alongside, the person is also assured of a death benefit which is 10 times the annual premium which is paid.
This way, an investor can explore several lucrative options for tax planning as well as investment strategizing through a life insurance plan over and above the traditional concept of a life insurance. For any kind of further details, feel free to contact us at the earliest. To remain updated from the happenings in the world of finance and taxation, subscribe to our YouTube channel at the earliest.